In today's video, I'm going to briefly talk to you about the 3 different types of life insurances that we have available here in our country. Now, the reason why I want to do that is because this month is very special for us. As you may or you may not know, here, the month of September, it is National Awareness Month for life insurance. So it's Life Insurance National Awareness Month. So I figured that it would be right for me to just give it a little bit of dedication about the 3 types of life insurance that are offered here in our community in the United States. So what are the 3 types of life insurances? Before I get into it, I'm going to briefly request of you that if you find this video of any value, that you hit the subscribe button and that you click to any of our social media here, follow us, and then just hit the bell notification button so that you know when we put up the next video, because I believe that we produce content that is of value to you or anyone that you may know. So please go ahead and subscribe. That's the only request, and that you may share this video with anybody that you may find it value as well. So the 3 types of life insurance is permanent, return of premium, and also the term. So now briefly, real quick, term life insurance. All it is just terms. It's the way it sounds. It just terminates itself. It is acquired for a certain period of time. You can buy it as much as 10, 15, 20, 30 years. And it doesn't cost a lot. So that is the upside of that. The downside of that is that it expires. But essentially, what is a term? So a term, it's a protection for now, just like any type of life insurance. It's a protection for now so that it can pay you off later on. So the purpose of that is that you make monthly premiums. So if you know or you don't know how life insurance operates, think of it like a car insurance, for example. You know, you get your car and also you pay your car insurance for that as well. You pay every month. You pay every month to an insurance company, whatever you're going to be covered, whether it's liability only or full coverage. And if you were to get into an accident, you will eventually get covered. If it isn't your fault, or if it is your fault, whatever that looks like, you will get covered up to certain coverage that they give you. This is exactly what it is. You get protected now so that you can be covered later on. So with term, it's very cost effective, and then you get to choose how long exactly you're going to be covered. As I was saying, you can be covered for 10, 15, 20, or 30 years. And again, it is very cost minimal, but you get a lot of coverage. You get a lot of coverage for just a little bit of minimum for that. Now, there are companies out there that believe that you should only get term insurance and invest the difference. That is great. That is a great strategy for you if it works for you, because some others might agree that that might not work for them. That worked for me for up to a certain period of time until I started understanding that maybe I can find a different way to make my money work for me. Not necessarily through insurance, but I'm just saying though that some companies believe actually that you should only get term insurance, pay very minimal, and invest the difference, and then get out of debt as fast as you can. One of the big believers of that, you need to get term insurance, is Dave Ramsey. Dave Ramsey tells his audience that you need to get out of debt as quickly as you can, as fast as you can. Put yourself into a term insurance so that you can therefore invest the difference, so that therefore later on in life, 10, 20, 30 years, you don't have the necessity for life insurance, because the purpose of that is that you're investing the money into a mutual fund, a stock, whatever that is, real estate, and later on in life, you don't have the necessity for that. Now that sounds great, but does it work all the time? Absolutely not. It doesn't work all the time, because everybody's situation is very, very different, as I said. And I'm going to touch that once I get to the return of premium, why I believe is that. One of the advantages that you have when you get permanent life insurance is that it costs very minimum if you get it at such a young age. When you're 18, 20, 30 years, it's very costly effective because you don't pay a lot for a lot more coverage. The older you get, the more insurance, the more premium you're going to have to pay for less coverage. But there's a possibility that you can turn it into a permanent insurance later on without having to do your exam. But also keep in mind that when you do open up a term insurance, you may be required to get a physical exam. So just always bear that in mind, because not everybody qualifies to get life insurance. So one of the things that I have here is the life insurance is not always bad news. It's actually a privilege to have, but you need to pay for that, because what it is, it's protecting your family. It's protecting not just you, yourself. Yes, it is protecting you, myself, in case that something was to happen to me. My family, whoever's behind me, they're gonna be covered. Nothing's gonna happen to them. Nothing's gonna happen to them in the sense that if my income doesn't come in for the night and I'm no longer here in this world, guess what? Because I chose to protect my family, for them to have some type of coverage when I'm gone. Therefore, they don't have to leave the house. They're not going to worry about having food on the table. It's going to be very different. The outcome of that, it's going to be very different versus if I didn't protect them and my family is very dependent on my income and I'm no longer here. Guess what? If I have a car payment, if I have a house payment, if I have necessities and they all depend on my income, that income is not going to come in for the rest of the week, for the rest of the month, for the rest of the year. They somehow are going to be forced to get out of the way to go make some extra income. If you have little children, how can you expect them to do that? So this is a concept that you need to wrap yourself around the head to perhaps maybe consider getting one of this, because it is very cost effective. You don't pay a lot for a lot more coverage. You can choose to have it in 10, 15, 20, 30 years. There may be an exam that may be required, so you may not even qualify. You know, for those of you that say, hey, I don't need life insurance, you know, nothing's ever going to happen to me. Well, what if you at one point say, you know what, let me give it a try, right? But then all of a sudden, you know, you were diagnosed with some type of disease or some type of sickness. I'm not saying that I wish that on anybody, but I'm just saying though that it could happen. I've seen it. And it may affect you on the way that you get coverage. You may have to pay a lot more. You may not be covered at all. You may only be covered for a limited amount of time. You might only be covered for a limited amount of money. It just depends. It varies on everybody. But term, that's essentially what it is. The next one, return of premium. Return of premium is just what it sounds like. It's a return on your premium. If I make my monthly payments for my 30-year term that I have, if at the end of those 30 years, nothing happens to me. Let's just say that I make $100 a month, right? By the end of the 36 years, that's $36,000. Nothing happens to me at the end of the 30 years. I get all of my money back. Those $36,000 come back to me. And a lot with term, by the way, you don't get that. You pay it just like a car, like you would pay for a car insurance. You pay it and that's it. It's gone. It's just protecting you for that time. Nothing else. Return of premium, you get that return on your premium as it sounds. So if you give $100 a month, 30 years, $36,000. In general, it's essentially good to be protected for all of your loved ones. As I was explaining to you, you pay now so that therefore you can get your money later. The downside of that, or I should say the upside of that, is that let's just say that for example, you're not really good at saving your money. And for whatever reason, you find it a struggle. You do want to get life insurance and you don't want to get term. Well, maybe a return of premium will be a good option for you, because you at the end of the 30 years, you're going to get all of that money back. There's really and it is guaranteed that they'll give you all of your money back. The downside to that, if you pay attention to how they work, is that you provide a free loan, interest-free loan to the insurance company. So I'm giving you my money on a monthly basis or a yearly basis, quarterly basis, whatever that looks like. You as the insurance company, you're taking the money that I'm giving you and therefore you're investing it into something else. Just like the banks. When you put the money in the bank doesn't even give you a 1%, but you have your money in the bank. Why? Because it is safe, it is protected. It is safe, it is protected. You're going to get your money back. It is guaranteed to get your money back, but they don't give you any interest. So that is the downside of that. You're providing a loan to the insurance company at an interest-free money that you're giving to them. So that is one of the downsides of that. The other benefit is that it can be added as a rider. So if you have a term insurance, you can add it as an attachment. You can say, so let's just say I have a policy, I can add it as an attachment that I can act as a return on premium. Now, one of the, this is good for most people that are on a budget, that have a monthly budget, they have limited amount of money, but they want to get protected. They understand the concept of protecting their loved ones, protecting their family. There's a lot of people, just because you have money means that you understand this. Just because you don't have money means that you don't understand this. It goes all different ways. There's a lot of people that don't make a lot of money, but they want to get insurance for their family. They want to protect it. They understand the concept. Well, guess what? With just a little bit of money, you can protect your family. This one, I get a lot of people that tell me, well, nothing's ever going to happen to me. I don't want to get life insurance. I'm okay. Okay, great. Get the return of premium, don't die, and get all of your money back. As simple as that. But again, most individuals have a really hard time. We have a hard time, as human beings, understanding the concept of, how these products work. So it is your job, your duty as the leader of your family, as a father, as a mother, as to whoever you are that you're watching this video, for you to do your due diligence and find out exactly what works best for you and your family. Because guess what? At some point, this worked for me. It no longer works for me, but you might be here. Guess what? Maybe you're here. That doesn't work for me. I don't like that. Why? Because I have a different idea. I have a different goal. I have a different view. But I'm not saying that this is wrong. I'm just saying that it could work for that person that says, well, I don't want to make payments a month, knowing that I'm never going to get that money back again. Great. Return of premium is guaranteed to give you all of your money back. You're putting it in a bank. You're going to get it 100%. But in the meantime, you're providing an interest-free loan to the bank so that therefore they can use your money, go ahead and invest it into something else while they make their assets. It's just like putting the money in the bank. With that being said, the last one. This is a permanent. This is a type of insurance that's going to last you for the rest of your life. And the two most popular insurances that we have is the whole life and the universal life insurance. Very different. They do not expire, and they act as a savings elements to your insurance. So basically what it is, they accumulate what is called a cash value. Let's just say that you're protected for $250,000. That is your death benefit. That is guaranteed that if something happens to you within those 30 years, that your family will get those $250,000 as a death benefit. 100% guarantee. In order for you to keep that insurance, in order for you to keep that benefit, you have to make a monthly payment, or a monthly premium is what insurance company calls them. Let's just say it's $250. If those $250, if you pay those $250, they go into, not all of it, but some of it goes into what is called a cash value component of the permanent insurance company. It builds cash value. Now, unlike the return of premium, where you give the money at a free interest loan to the insurance company, your money is being invested, and it is invested into an index that mimics the S&P 500. Whatever that index might look like, that's what it mimics. It replicates some of the indexes. The most popular is the S&P 500 in the stock market. So your money gets invested, and you get some type of interest rates back as your money starts to accumulate cash. Now, it's a favor for tax treatment, because when you can pull out money from that, by the way, you act as your own bank. So there's a minimum waiting period that you have to wait. It's anywhere from 7 to 10 years that you cannot touch that money. The money has to sit in the insurance, in the company, in the account for you to touch it. Now, let's just say 10 years pass by. You want to go ahead and help out your kids. You want to help out your grandparents. You want to buy a house per se. Now you can go ahead and touch that money. You can go ahead and borrow against your own money at a tax-free, because when you borrow a loan, when you go out to the bank and then you borrow against it, when you take out equity from your house, when you take out money from your insurance company, that is a loan that you're doing, the IRS does not count that as taxable income. So therefore you evade all of the taxes. Now, that's great. You have to pay the money back to the insurance company, to yourself. So that's why I said you act as your own bank. You're taking out the money from your own account. You're paying yourself back that money, and you're paying yourself back that interest. You understand? So that is what Walt Disney and Ray Kroc did. He had a index universal life insurance. So what he did is he borrowed against it in order to continue the project to build Disneyland. That is why we have Disneyland. Can you imagine if Dave Ramsey goes and tells Walt Disney, you shouldn't have an index universal. You need to have a permanent and invested difference. Things would have played out very differently. Things played out exactly the way they needed to be played out in order for us, for you and me, to be able to take our kids and have them, be at Disneyland, have a good time. But he did that through a universal life insurance. Ray Kroc, he bought McDonald's in 1961. He did the same thing. There was a point where he could no longer pay his employees. So what did he do? In order to keep the business running, he went ahead against his own life insurance and bought McDonald's in 1961. That is why we have McDonald's all the way across the world, and it's worldwide recognized. And it was all because they had a index universal life insurance that allowed them to act as their own banks, borrow against it, and then pay that back to themselves. So that is how permanent works. They do have higher premiums. Keep that in mind. Let's just say that you're covered for $300,000 here for $50, $25 a month. Here, $300,000 you're covered. Your payment's probably going to look like anywhere from $250, $300 a month. Why? Because the insurance is taking more risk on you in order for you to accumulate more cash. Your premium is higher, but your coverage stays the same as if it were for those two. This one expires. This one never expires. You stop paying after those 30 years. Guess what? That is for you to keep. You keep borrowing against your own money. You keep paying it back. You act as your own bank. Think of it like this. It's a bank that you're buying, and it's protecting you at the same time, protecting your family at the same time, and you're borrowing from that. You go to the bank, you say, Mr. and Mrs. Bank, I want to borrow $1,000. Okay, great. Here is $1,000. You're going to pay that back to us in 6 months at a 10% interest rate. No taxes. Here, you go to the insurance, Mr. and Mrs. Insurance, I want to borrow against my own cash value policy, my index universal. Great. How much you want to borrow? $10,000. Okay, great. Now, here's $10,000. You're going to pay that back in X amount of time at a so much interest rate. And you pay that back to yourself because that is your money. You're not paying back to the insurance any interest. You're not paying that money back to the insurance company. You're putting that back to your own account. You get that concept? You're acting as your own bank. I keep saying that over and over because even as I'm telling you all of this, I'm starting to understand even more that, wow, not a lot of people can understand how this really works because we get so caught up into the fact that I'm paying more money and I really don't understand how this works, versus it's easy for me to say that I can get this for more coverage for a less amount of time. But if I'm not good at saving that extra difference, if I'm not good at paying off my debt, and because I'm paying 50 here and I'm paying 250 here, but I choose to go with this one, now I have $200 of disposable income. Guess what, honey? Let's go have some dinner, honey. You wanna do this? You're robbing from your future self. That's what I always like to call it. You're robbing from the future self, and the next thing you know, you're using credit cards. You're going to the bank. You're getting car payments. You're getting into a massive amount of debt. When here, you're getting educated. You're understanding the concept of what it is to have a permanent life insurance at the same time. Some of the index universal, they come with living benefits. Now, what are living benefits? Living benefits are if you get a chronic illness, you can't do any of the 6 daily activities. I can't get up and walk. I can't change myself. I can't bathe myself. I can't feed myself. I can't drive myself. If you can't do any of those activities, you get the money in advance. Not the money that you're paying to the insurance company for you to have the death benefit. But now let's just say your coverage is $250,000 in coverage. Rather than you, the company waiting for you to die, you get that money in advance while you're still alive. You're getting that in advance, but that's why they're called living benefits. Life insurance is not always about you having to die in order for you to use the life insurance. Remember, here, you can act it as your own bank. You can use it while you're still alive. Here, you cannot. It's just a premium that you're hoping nothing happens to you, but in the event that does happen to you, the insurance company will pay out your family. Same thing here. However, with that comes the ability to be able to act as your own bank. And then also, if something was to happen to you, but you didn't die for that chronic illness or that accident that happened to you, and God forbid something happens to you where you can't walk, the insurance company will advance you that death benefit, those $250,000 in monthly payments to you while you still get to keep your insurance. Now, again, not a lot of people really understand how permanent insurance works because we get so caught up in the fact that it has this type of fee. Yes, it does have some type of fees that I have to pay more for the same amount of coverage than this, but without really understanding the concept. And then it's okay. It's understandable. Mr. Mrs., you are your own bank thanks to this type of coverage, index universal or whole life insurance. Whole life and index universal operate very differently. I believe that without, I'm not giving any suggestions. I'm not giving any advice because that is not the purpose of this video. The purpose of this video is just to tell you the differences of what insurance, type of insurances are out there and how they work. So return of premium is just you're making your monthly premiums. You will get your money back 100%. It's just like you're putting it in the bank and then just leave it in the savings account, letting the bank do the work for you, getting interest in that money so that the bank can therefore use it to buy more asset while your money is just sitting in the bank and you're gonna get that 100% at no interest. Return of premium is just like paying your car insurance. It will expire. It's just a type of insurance that it has only the death benefit. If something was to happen to you, that's what you would get. So life insurance is not always a bad news. As I was saying, it can act in different ways other than you having to die. As I get into it, I'm not gonna touch it anymore, but it can act in different ways. Life insurance is not just you having to die in order for you to get that benefit. And one of the things that I always tell individuals when you are thinking about perhaps covering yourself, getting life insurance, to detach from the idea that it is about you, that you are the one that has to make the payments. Yes, it is you that has to make the payment, but it's no longer about you. So if it hurts you to pay $50, $100, $200 a month, guess how much it's gonna hurt your family the day you're no longer here. God forbid something happens to you and they're very dependent on your check. What's gonna happen to them? How hurt they're gonna be just because you were unwilling to protect your family. So this message it might offend you, it may not offend you, but I'm calling you out. I'm calling every single one of you that has always known that it is the good thing, it is the right thing for you to do to protect yourself, to protect your family in the event that something was to happen to you. My challenge to you is now that you have this, now that you have the ideas of how they work, what are you gonna do about it? Are you just gonna sit down and say, okay, that was good information, that was it? It's great. I still think though I don't need life insurance. Nothing's ever gonna happen to me. That's what a lot of people say. Great. Perhaps some of this will work for you. Get all of your money back. I don't have the budget right now. I really can't afford it, but I need to protect my family. No problem. There's the term insurance. You know what? I actually make excessive amount of money, or I make decent amount of money. I just don't know how to invest it. I can't afford to buy a house right now, but I do want to buy a house in the future, and I want to invest my money, but I really don't want to put it in the bank because I know that it's not going to save me interest. And by the way, I just don't know how to save. I just don't know how to invest in the stock market. Crypto, forget about it. I'm not good at crypto. Collectibles, I don't know nothing about collectibles. Cards, don't even mention it. Perhaps an index, a permanent universal life would work for you because some of your money is going to get invested. It's going to work for you. Yes, you're going to have to pay higher premiums, but in the event that something was to happen to you, and if nothing happens to you, your family is protected. That is for you to keep. So now that you have those 3 ideas, my challenge to you is, what are you gonna do? If you are the leader of the house, are you just gonna, let this opportunity pass by? Or are you gonna say, you know what, it's time for me to cover my family? This is the month. This is the month. This is the time where you get to make that decision, and you say, enough is enough. If I don't make this small step towards what is right, when am I ever gonna take that next step to where I wanna be? Where I wanna be? This is the opportunity for you. This is September, the month of life insurance awareness, for you to take advantage and find out how they really work. Get on Google, find out, your local agency, call one of your buddies, whoever's in the insurance company, call them up and tell them, hey, you know what? I'm ready. I want to do this. It's time for me to protect my family. This is the month where you say, enough is enough. I'm taking action. That is my challenge to you. So if you find that of value, the only thing I request is that you subscribe to the channel, hit the like button, and then just share this with anybody that you think may find this of value, as we continue to provide value to you and everybody around you, so that we can therefore continue to give you more content. Until then, take care everybody, and I'll see you in the next one. Bye-bye.